Hello and welcome to the very first edition of Money Management 4 Minutes for this year. 2011 is going to be an eventful year for the financial services industry, with further developments around the proposed future of financial advice reforms. And this week we find advisor sentiment slowly recovering after a period of negativity last year following the FOFA announcement. But more on that later. First is your weekly news roundup. The industry super network sparked a fiery debate around the opt-in proposal, using research undertaken by Rice Warner to claim opt-in costs would be negligible. Commissioned by the ISN, Rice Warner research found the establishment and ongoing costs associated with opt-in would amount to $28 million of the $1.6 billion in fees the financial planning industry generates each year. The Financial Planning Association chief Mark Rantel responded to the findings, saying the opt-in proposal would harm more Australians than it would benefit, and that the association was tired of the industry fund one-track agenda. Meanwhile, the Financial Services Council proposed an alternative to opt-in, suggesting a 3-year renewal framework which would allow consumers to opt out at any time. SPA patron Sir Anthony Mason said intra-fund advisors should not be exempted from the statutory fiduciary duty requirement. Mason said the reforms needed to be clearly drafted, explicitly identifying persons on whom the duty would be imposed. Half-yearly results are out, and Perpetual reported a 29% profit decline in the 6 months to 31st of December 2010. While public listing of Count Plus helped deliver its parent Count Financial a record net profit of over $42 million. Earthquake and flood-related claims have hit Suncorp's results, with the group posting a net profit of $223 million, $141 million less than the prior corresponding period. Chief Executive Officer of the collapsed Sonray Capital Markets, Scott Murray, pleaded guilty to charges originating from ASIC's investigation and awaits sentencing. Meanwhile, the regulator banned former Storm representative Stuart Drummond from providing financial services for 4 years. Former head of advice at Colonial First State, Paul Barrett, has moved to ANZ, where he will head up distribution and advice. And finally, SPA recorded a 50% jump in membership in less than a year, reaching 2,000 members. In this week's Money Management, Caroline Munro reports on claims that ASIC publicly admitted its FOFA approach was suboptimal. We find the advisor community concerned over the yet-to-be-released government's paper on the statutory compensation scheme. And Mike Taylor reports on the mildly recovering advisor sentiment following a period of negativity in 2010. We spoke to Vanessa McMahon from Wealth Insights.
Yes, advisor sentiment is coming back again from the lows that it reached last year when the future of financial services reforms were announced, which coincided with a setback in the stock market. But since then, the advisor sentiment has slowly been creeping back, although it's still not terribly high, with a lot of advisors still reporting that times are just average for them at the moment. They're finding organic growth very hard to achieve. A lot of advisors are also very cautious about reinvesting into the markets. A lot of advisors report that they can get a guaranteed 6% return or more with a term deposit, and that they're not willing yet to take the risk to invest back into the volatile markets and risk getting negative returns.
For all the details on those stories, see tomorrow's issue of Money Management. Thank you for joining us this week. Bye for now.